Paul Mortimer-Lee from BNP Paribas is joining me now. Paul, welcome. Just taking a look at Greece, reports today suggesting that we're heading back to square one. Do you think that's a fair analysis?
I think it's a fair analysis and something that's entirely reasonable. What we've seen is a pledge by the Europeans to throw Greece a lifeline if they're drowning. And that gives no support if they're not drowning, if they're just struggling in the water. And the longer-term worries about Greek solvency have not been addressed at all by what we saw from the Europeans last week. It's really saying, if there's desperate need, we'll step in with some liquidity aid, but that doesn't cure the underlying problem, which hasn't changed over the last week or so, and it's entirely appropriate that the bond spread has gone back out again. I suspect what happened is a number of banks in Greece, for example, were encouraged to take up the offer and took it up, but then don't really want to hold on to it, and that's why we've gone out again in terms of the spread.
Is there a way to cure the underlying problem without calling in the IMF, or is it more sensible just to put everyone out of their misery and call the IMF in now?
Well, I think it's probably more sensible to call the IMF in now. You get some cash in, about $15 billion we would reckon. It's not an awful lot of money. It would help them this year over the funding needs in the next few months. And it would come up with a program. Essentially, they borrow IMF credibility. But they've got a long, long way to go in terms of bringing the budget deficit down. And IMF money this year would not help them next year, for example. So it's a temporary palliative, not a cure. And at the end of the day, the Greeks have to perform. They have to bring their budget deficit down in a very serious way and keep on doing that. The problem for them is that they lack credibility, and that's why they're being forced into such a massive adjustment this year, 4% of GDP. And the real worry is that if you tighten by 4% of GDP when your economy is already contracting, then you're going to make the economy contract more, and that's going to make the fiscal adjustment very difficult to achieve. And that's really where we are. We're in a very difficult position, and I think towards the end of the year, we could see disappointing GDP figures coming out of Greece.
Now, looking at the PMI figures that have just broken this morning, they are fairly good, but I guess starting from a pretty low base, right?
Well, yes, but they are very good. A couple of months ago, it looked like the European PMIs were flattening out just above the 50 level, and then they've taken this step upwards. I suspect that what's happened is, as we've gone into the new year, people are not as pessimistic now as they were a year or so ago. And I think some of the delayed investment projects that were mothballed around the world are now coming back on track. And that's feeding through to the PMI in Europe. Remember that the PMI in the US is already strong. With the Chinese PMI this morning, that was strong. So global manufacturing seems to be doing very well. The question is, will it spread to the rest of the economy? And if you looked at the German retail sales figures that came out today, they were continued to be very disappointing. So it's very much a two-speed world in Europe. Manufacturing doing well because that's based on external demand, particularly for investment goods, particularly for German investment goods, particularly from China, but the domestic economy remains mired in recession.
So this idea that manufacturing will be the driver that will pull us out of recession, it seems to me that you're saying that that's not necessarily the case if people don't spend.
Well, it's got to spread to the domestic economy. So the two things that traditionally happen. One is it spreads to investment demand. That seems to be happening to some extent, but I don't think it will be as strong as usual. And then secondly, it's got to spread to employment and therefore to consumption. But as we heard in the earlier, employment's being held up by various job sharing schemes, for example, in Germany and Italy. Probably unemployment is 3 percentage points lower than it would be otherwise. And these underemployed workers, as the recovery proceeds, the degree of underemployment will be reduced, but firms won't be hiring new workers. And so if they're not hiring new workers, then you can expect consumption will remain very sluggish. And so the recovery will not build the momentum that we're used to in past recoveries.
Just before I let you go, Paul, would you still class the recovery as fragile, and are you more or less optimistic than you were?
I'm more optimistic about Asia, I'm more optimistic about the US, and I'm less optimistic about Europe. And the reason is that Europe does not have a self-sustaining recovery because it does not have strong domestic demand. It's entirely dependent at this stage upon exports. And that leaves it rather fragile to bad news on the fiscal front, for example.
Okay. Paul Mortimer-Lee, thank you very much for joining us this morning.
Pleasure.